Hey, chapter one is when we discuss a lot of the terms that we're going to use in this course. A lot of what you're going to learn in accounting has been called, not by me, but by plenty of other people. Too many, so I don't even know who to give credit to. But accounting is really, when you're learning accounting, especially in accounting principles, is learning the language of business. So a lot of the terms we're going to use are impactful no matter what business major you are. Accounting, obviously, but it could be management, marketing. It doesn't matter the major. It will help you understand business better. In addition, you learn about a little bit about accounting while you're taking this course. So I think if you take it from that perspective, what can it do for me if I'm not an accounting major? Obviously, you'll understand business a lot more because you'll understand a lot of the terminology. So I'm not going to go over the objectives, but I am going to look at the definition of accounting. So accounting is an information and management system. That means there's a way we do things. There's a certain way we do things, a certain way we measure, certain ways we gather information and report that information. So it's a whole system set up, designed to gather, collect, report information and to measure things. And exactly what is it doing is identifying, recording, and communicating an organization's business activities. Now, just like I said, it's called a language of business. It communicates data, like financial data most of the time, and it helps users make better decisions. Because we have this accounting information or financial data, then businessmen and women can make better decisions. All right, so using accounting information. It's divided into two groups. There's external and then there's internal. Not directly involved with running the company. So you can work for the company and you're still, in many ways, external. So let's dig into this a little bit more. To have limited access to the company's information, examples of shareholders, lenders, directors, external auditors, non-managerial. So you can work for the company and you're not in a key leadership position, so you don't know the whole accounting information. Non-executive employees, labor unions, regulators, etc. Right, and then internal users are, senior executives, upper level management, people working in accounting, managerial accounting, people preparing reports. Right, so ethics is huge. Okay, very huge. Fraud triangle. It's in the book. It's interesting. I'm getting my doctorate right now, and one of the students I'm going to school with had a paper looking at modifying the fraud triangle that's in your book. So they wanted to change it from maybe, and I can't remember what she did. I don't know if they're changing it to a square or something, or maybe swapping out one of the points in the fraud triangle. But the fraud triangle that we have is the one that's been used for years and years and years, and it does a pretty good job of explaining how fraud could come about in a company. There's three factors that must occur or can occur for fraud to occur. So opportunity, you can do something somehow to commit fraud. The person committing fraud can have pressure. It could be financial pressure, family, lifestyle, divorce, whatever the case is, to commit fraud. And then somehow or another, they also rationalize committing the fraud. Well, the company owes me, or this happened and it's not fair, whatever the case is. So these three are the points on a triangle, 3 points on a triangle. Gap, that's not the store. We got an extra A here, so that's 2 A's gap, not the store, that's 1 A. Probably never be able to shop at the store again without thinking of accounting. All right, so anyway, generally accepted accounting principles, concepts and rules that govern financial accounting. Now, I want to go back before I go any further because I'll forget. It says generally accepted accounting principles. It isn't accounting rules. These are generally accepted accounting rules. There's more than one way to do things sometimes, and the company has leeway depending on the industry they're in to pick and choose what's best. And plus, there's tons of different industries. So we can't say everybody needs to do this, because a company that manufactures airplanes or makes boats or a bank or a small business, they're all different, and the accounting for them could be somewhat different. So it's generally accepted. Generally, we agree to these principles, and sometimes you have a choice, and it's not like a list of commandments, not a list of laws, okay? Guidelines. We want you to do certain things, but within that, there's some leeway, and you can do things differently, okay? That's a conversation that can get really detailed and everything. So just remember GAAP, GAAP. That's who makes, and I'm going to make it sound like it's rules now, concepts and rules that govern financial accounting. You don't want to go against GAAP. You want to be in compliance with GAAP. The conceptual framework. This is important to know for the first exam. A lot of terminology on the first exam. Measurement principle, or the cost principle. Cost is measured on cash or equal to cash, okay? All right, and then objectivity. Let me tell you, that is just huge in accounting. Our accountants and auditors, regulators, we want everybody to be objective. So we want everybody to be unbiased, independent. I mean, when you work for the company, it's hard to be objective, right? So maybe the company accountants aren't as objective as an external auditor. An external auditor who's auditing the company doesn't work for the company. They certainly should be a lot more objective, right? Revenue recognition principle. Revenue is recognized when goods or services are provided to customers at the amount expected to be received. So, does this say anything about they got cash there? GAAP says we can record revenue when you have completed, you have done whatever the customer asks you to do, and now you can be paid. You don't have to be paid. So you can record revenue even though you don't have the cash. Now, my checkbook and your checkbook doesn't work that way. The only thing going into that checkbook is a deposit, is the money I actually have. We're not talking about the bank here. We're talking about recognizing revenue on our accounting system. So we can recognize revenue even though we don't have cash. Then we're going to match expenses with revenue. So we want to make sure that the power bills in the month we earn the revenue. We want to make sure revenues and payroll are in the same month together. So wages are in the same month, we earn those revenues. So we want to match expenses with revenue. Full disclosure says we want to record all the details in the financials, and sometimes we have to put footnotes to the statements. Accounting assumptions, going concern. We assume this company is going to be around going forward. It's not in jeopardy of no longer being successful and needing to file bankruptcy and disappearing forever. Monetary unit assumption, we're going to assume that when we're doing accounting in America that it's in dollars. That's about all there is to it. Time period assumption, days, weeks, months, quarters, years. Those are artificial constructs. A company exists for a period of time, does things in a period of time. Just say they build cars for a living, right? So model year comes out. It's the strangest thing. I never have understood. It's probably a reason, and I'm not going to look it up because I don't care that much. But you can get a 23 model now. And at the date of this recording, it's July 10th, 22. But you can get the 23s are coming out. You never have understood that. All right, but anyway, so time period assumption. Cars do things that are like that, right? They're building and selling cars with the model year of the next year right now. So it's an artificial thing. We divide monthly, quarterly, annual. Artificial time constructs to measure how things are going, and it gives us good comparative basis and makes very useful reports. Business entity. If you start a business and it's a corporation, we're going to assume that corporation is one entity and you and your personal finances are another. Very good for decision making. There's a lot more there that we could go into, but I'm not. Different kinds of companies. We're going to be a sole proprietor. That's one person, one ladder, and a pickup truck for, partnership. It could be two people, one truck and one ladder. They're basically self-employed people doing business together. In both cases, it's unlimited liability. Somebody falls and gets hurt, they sue the company and the business. Sole proprietor partnership. Corporation is a separate legal entity whose owners are called shareholders or stockholders. The owners have limited liability. Their liability is limited to their investment in the corporation. So if somebody falls and gets hurt, they sue the company. They can't sue the shareholders or the stockholders' personal assets like the house, the car. They can only sue them for the business, their stock investment. Right? So it's responsible. The entity would then be responsible for his own business income tax, and the owners are responsible for their personal stuff. Accounting equation, this is huge. Make sure you learn it. Make sure you learn it. This is huge. Make sure you learn it. Okay? Assets equal liabilities plus equity. All right? So assets are resources the company owns or controls. Liabilities are they owe people. Wages payable, accounts payable, notes payable, taxes payable, payable. That means they owe money. Make sure you learn that payables are debt, liabilities. Equity, hopefully there's equity in the company. So assets minus liabilities. So if assets are 100 and liabilities are 50, equity would be 50 because it's 100 minus 50 equals 50. Different types of equity there. We'll be covering those more. Please read this. Don't go over it like I just did. Make sure you read it. And then lastly for this video for chapter 1, return on assets, ROA, it measures profitability. There's also something called ROI, which is return on investing. So we love ratios. They're a way to compare quarter to quarter, year to year for the company. And it's also a way a company can compare themselves to others in the industry, other companies in the industry. So it's very important ratios. All right. So a good analysis tool to be familiar with. And that concludes Chapter 1, a lot of memorizing, a lot of it that'll become more and more familiar to you as you complete this course.